Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is the 19th of May. Let's dive into the week's stock market news. European markets rise amid trade hopes, diverse economic signals. European equity markets posted gains as sentiment improved following a de-escalation in trade tensions between the United States and China. The Pan-European Stocks Europe 600 index advanced last week by 2.10% in local currency terms. Major national indices mirrored this positive trend. Germany's DAX increased by 1.14%. France's CAC 40 index climbed 1.85%. Italy's FTSE MIB saw a significant rise of 3.27%. And the UK's FTSE 100 index added 1.52%. Economic data from the UK showed the economy expanded at its fastest rate in a year during the first quarter, ahead of the imposition of US tariffs. Gross domestic product GDP grew by 0.7% sequentially, surpassing the 0.6% forecast by Reuters and marking an acceleration from the 0.1% growth in the final 3 months of the previous year. This expansion was primarily fueled by strong performances in the services sector, increased investment, and a rise in exports. However, alongside the robust GDP growth, the UK labour market displayed signs of cooling at the beginning of the year. The unemployment rate, based on the labour force survey currently undergoing an overhaul, edged up to 4.5% in the 3 months through March, a slight increase from 4.4%. Data from the tax office revealed that the number of payrolled employees registered the largest fall in a year between February and April. Private sector wages, excluding bonuses, a key indicator of underlying inflation pressure monitored by the Bank of England (BoE), showed a 5.6% increase in the January-March period compared to a year earlier, representing the smallest rise since the 3 months ending in November 2024. Against this backdrop, Bank of England policymakers offered varying perspectives on the inflation outlook and future interest rate path. BoE chief economist Hugh Pill warned that inflation in Britain might turn out to be stronger than the central bank currently anticipates, suggesting that interest rates could need to remain higher than market expectations. Meanwhile, at a BoE conference, policymakers Claire Lombardelli and Megan Green, who had voted in favour of cutting rates at the central bank's most recent meeting, highlighted persistent inflationary pressures within the labour market and advocated for caution regarding further rate reductions without more conclusive evidence of receding inflation. Across the Eurozone, recent data pointed to strengthening economic activity. Industrial production saw a significant jump of 2.6% in March, exceeding the 1.1% increase in February and suggesting the sector is emerging from a 2-year recession. This monthly expansion was driven by strong increases in the output of capital goods and durable consumer goods. Germany, the Eurozone's largest economy, reported a particularly strong surge in industrial output, rising by 3.1%. Furthermore, the Eurozone's trade surplus reached a record €36.8 billion in March, a substantial increase from €22.8 billion a year prior, largely boosted by a sharp rise in exports, particularly towards the US. Employment also grew in the first quarter, increasing by 0.3%, an acceleration from the 0.1% growth observed in the preceding period. Now our insight into alternative markets, the robotic assembler line. Humans as overseers in the automotive future. The automotive industry is undergoing a profound transformation on the factory floor, driven by the relentless march of automation. A new production paradigm is emerging where robots are no longer merely assisting human workers but have become the principal protagonists of the assembly line. In these advanced manufacturing environments, complex mechanical arms, automated guided vehicles AGVs, and sophisticated robotic systems handle the vast majority of physical tasks, from welding and painting to precision assembly and quality inspection. In this highly automated landscape, the role of the human workforce is fundamentally redefined. Rather than engaging in repetitive or physically demanding labor, employees are transitioning into crucial roles centered around management, monitoring, and strategic oversight. Their primary responsibilities involve ensuring the seamless operation of the robotic systems, monitoring production flows, analyzing performance data, and intervening only when necessary to address anomalies, perform complex maintenance, or optimize programming. Humans provide the cognitive layer, verifying that the automated processes are functioning correctly and maintaining the high standards required in vehicle production. This shift towards a robot-dominated production process yields significant advantages. Robots can operate continuously with unwavering precision and speed, far exceeding human capabilities for repetitive tasks. This leads directly to dramatically enhanced productivity, faster cycle times, and consistent product quality with reduced errors and waste. The ability to maintain high output levels around the clock provides manufacturers with a substantial competitive edge in a demanding global market. The tangible benefits of increased productivity and efficiency directly contribute to creating greater value for shareholders. Optimized operations, lower production costs per unit, and improved product quality translate into stronger financial performance and increased profitability. Companies that successfully implement these advanced robotic systems can achieve higher margins, greater market share, and a more robust return on investment, all of which positively impact shareholder value. While initially driven by large automotive giants, this trend is increasingly relevant for a wider range of private companies within the automotive ecosystem, including Tier 1 and Tier 2 suppliers. As robotic technology becomes more flexible, easier to integrate, and potentially less capital-intensive over time, more businesses can leverage automation to enhance their productivity, reduce costs, and improve quality. By embracing this robotic revolution, many private enterprises stand to gain significant competitive advantages and unlock new avenues for profitability in the evolving automotive business landscape.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.